Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I don't know, fixed income market. I feel like I can just sit around in my 2-year U.S. government treasury bond and get 4.2%. I don't need to be a hero and take credit risk. I don't know. Some people may want to take a little bit more risk. Kathy Jones may be one of them. She's chief fixed income strategist for Charles Schwab. She joins us here in our Bloomberg Interactive Broker studio. So, Kathy, we sit back here. Fixed income actually has some green on the screen in total return in 2024. You guys actually made some money this year in fixed income.
Oh my God.
I mean, 2022, brutal. I mean, let's be honest. What do we do in 2025? Because there's a lot of unknowns out there, Kathy.
Yeah, I would say when we were putting together our outlook this time around, we try to model out various factors. And this is probably one of the hardest years of my career to model out because there's so many policies that are up in the air that it's really hard to predict how it's going to come out. But our status is really that the rates have very little room to go much lower at this stage of the game. We should get a couple of more Fed rate cuts, but not nearly as much as we were expecting before. And long rates are kind of well priced right here. If you look at the 10-year yield, it's probably pretty close to fair value. And then you have all these uncertainties, which is the word of the year, I think, around trade, tariffs, immigration, taxes, all these policies that could affect the growth and inflation outlook that keeps us kind of cautious.
Sean Donnan and Anna Wong here at Bloomberg have a great piece out kind of tapping into that uncertainty and looking at sort of how this might play out when it comes to tariffs, when it comes to trade policy. They write that the drama has started immediately. Tariffs may build more gradually. What is your sense of how this rolls out? And I know there's a lot of speculation about how inherently inflationary a lot of this might be. How are you thinking through, A, again, how the policies are rolled out, if in fact they are, and B, what that might mean for inflation in this country?
Yeah, I think there's the one basic question is this a negotiating strategy or is this for real? So far, it sounds like it's for real. It sounds like something the president-elect believes in. And so some sort of tariff is likely to be imposed on somebody early on. We're assuming China will be first up. We may get some negotiations on Mexico, Canada, et cetera. But some level of tariff seems likely to us. So we're looking at that as a one-time shot on inflation. So it doesn't necessarily build inflation over time, but it definitely will raise the price of those imported goods. At the same time, it tends to slow economic growth. So you have this kind of dueling force that comes from tariffs. But we are assuming some inflation impact, at least in the early part of the year, middle part of the year.
I mean, to me, it seems like from an inflation risk situation, the actual immigration policy might be the most impactful, it seems, because I just know a couple of restaurant owners that I know in town. They're saying for the first time in several years, they're fully employed. Their kitchen, they got everybody they need in their kitchen, their dishwashers, the busboys and all that kind of thing. And I don't know, you take that away and that could be problematic because I would think that's a relatively big part of the nation's labor force at this point. How does that work?
Yeah, if the proposals that have been put on the table were implemented, we'd probably lose about 8%, up to 8% of the workforce.
Wow.
That's a lot in an aging workforce with people my age and older retiring out. That's not an announcement, but that's going to happen. It is happening as the baby boomers, and you need workers to replace them. So far, in recent years, it's been immigrants who have replaced them. So you end up with this hole in the labor force, and you can't grow as quickly. So on the one hand, wages would probably have to rise to attract people who aren't in the labor force. On the other hand, you can't grow as fast because you don't have the workforce to produce goods and services to grow faster. So it is, I would agree, longer term, it's a bigger issue probably than tariffs.
We're all dealing with this uncertainty. You're doing it in your outlook, and certainly Fed Chair Jerome Powell is doing it too, even if he so studiously shied away from talking about it at the last Fed meeting. He's got another event this week, a moderated sit down on Wednesday, and then we're looking ahead to the next Fed meeting after that. Does he have to address this more the way that he and his colleagues are thinking through all of the uncertainty? We're going to get that summary of economic projections at the next meeting. How do they factor in all that we don't know of what might happen here in the months ahead?
Well, I do think the dot plot and the rest of the summary of economic projection is going to be really interesting this time around, and certainly will change because if you think back to September, it was an entirely different kind of economic outlook and political outlook, policy outlook. So I think it will change. I think they're probably busily trying to model out some of these things themselves and figure out what that means, but I doubt that he will talk about that at this stage of the game. We'll find out about that later. But my assumption is they're going to be much more cautious about rate cuts than they had been before because A, the economy has been more resilient than we thought in September, and B, we have all these uncertainties on the horizon.
Year to date 2024, the best performance in your world fixed income, U.S. corporate high yield, and U.S. leverage loan index. That surprises me a little bit because I know there's concerns throughout the year of maybe recession, yet the riskier parts of the market were just really performing.
Yeah, well, we did have a more resilient economy, so that helped. And it's the power of the coupon. So if you have a coupon of 6, 7, 8%, and even if things sort of hold steady, you're going to perform pretty well. And I think this year, when you look at the total return of various asset classes, a lot of them are in line with the coupon, the average coupon of the year, and that's kind of what we're looking at.
Can I ask you lastly just about the strength of the dollar going forward and what you're thinking about when it comes to Forex and currency? And we had this kind of another announcement over the weekend from the president-elect about BRICS countries trying to rival the dollar. Kind of wonder where that came from. I'm sure we'll talk about that more when Damian Sassower is here in a bit. But what's your sense of sort of what dollar strength looks like if these policies, if immigration and tariffs, if those policies are put into effect, what does that mean for the U.S. dollar?
It means it stays strong or goes higher. It'd be very difficult for the dollar to push the dollar down at this stage of the game if you have those sorts of policies in place. And, you know, the dollar is near, if you look, I use the Bloomberg dollar index. I prefer it to the DXY myself because it's more broad-based. It's nearly at a 15-year high. We're almost back to those spike highs in 2022. And that's driven largely by the outperformance of the economy and the wide interest rate differentials. I doubt those things will change in 2025. And actually, tariffs will only give it another boost to the upside.
Kathy, thank you so much for joining us. As always, appreciate it. Kathy Jones, she's Chief Fixed Income Strategist for Charles Schwab. The fixed income folks actually making some money this year. We love that.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The appointments from President-elect Trump continue to come fast and furious. Kash Patel, FBI director appointee, is probably one of the latest over the weekend. Henrietta Treyz joined us. She's a managing partner at Veda Partners. Henrietta, again, kind of putting some of these appointment selections in context. What is President-elect Trump trying to do here with his cabinet? What is his strategy, do you think, at this point?
I think it's definitely signaling that he wants to hit the ground running as soon as he gets sworn into office, January 20th. The most important things to me are the nomination of Kevin Hassett and Jameson Greer. Those are the names that were floated last week for USTR, which is going to be most critical for putting the tariffs into place. We know we have the Treasury Secretary into place. Some of these other names, whether it's RFK Jr. or Matt Gaetz, and those guys are sort of fallen by the wayside or will be contentious as they go through, as I imagine Kash Patel will be as well. But I would say keep our eyes on the prize, focus on USTR, and see also that they're potentially telegraphing to businesses to prepare for these tariffs in advance, as opposed to waiting for January 20th and an implementation date of additional tariffs. That's maybe the biggest thing for me right now with the early naming of these nominees.
Let's take each of those in kind. Let's start with Kevin Hassett. He was in the first Trump administration. He came up with this thing called the Hassett Principle when it came to tariffs, sort of focusing on where those tariffs might be applied, who might be exempt from them. How does his work change if he's now a part of this next administration? I mean, I look at just sort of the panoply of people that the president-elect has picked to be on his economic team, and we've seen kind of the fighting early on before they were even named, and one wonders if that's going to move over into the cabinet room as well. But sticking with Kevin Hassett, what role does he play in shaping the direction of Donald Trump's economic policy in this next term?
The most important thing to me right now is that he has a relationship with lawmakers on Capitol Hill that exceeds that of Scott Bessent or Howard Lutnick. And I think when I am worried about next year is obviously the tax bill and then the tariffs that are part of that. In that Donald Trump has said the tariffs will pay for the $4.6 trillion extension of the existing tax rates. So when when Hassett is up on the Hill trying to talk with staff and get this tax bill written, one of the key components that he's going to be involved in is getting them to agree to include tariffs in the tax bill. That's a very big deal. That's the only way to score it so that tax legislation can be physically offset in the same piece of legislation by the tariffs. So I think Hassett will play a really important role there, as will the USTR.
Henrietta, what's the role of the United States Senate here in confirming some of these nominees, particularly some of the more contentious ones that may be coming down?
They were pretty much already trying to compel the Trump administration to, give them names that can get through quickly. We know that historically you get through, the Secretary of State, Defense, and Treasury pretty quickly, just days after the president is sworn in. So they're trying to, sort out the wheat from the chaff as early as possible so they can keep their eyes on the prize, get started on the president's agenda as soon as he gets sworn into office. So I think a lot of their backroom discussion is trying to say, look, thank you for giving us these names. Some of these guys cannot get through. I think it's underappreciated how slim the Republican margin is going into next year. We have a number of senators who are going to be up for re-election or potentially retiring or have come in as freshmen who will be willing to challenge the president on these nominations, as we've already seen.
We're back playing this game of trying to keep track of all of the social media posts from the president-elect, and one of them from a few weeks back had to do with recess appointments and him urging senators to allow for them to happen, presumably because that would forestall having to go through a lot of the confirmation process where, perhaps some controversial material might come out and things could get gummed up. Where does that stand? How resonant was that message from the president-elect with Republican members of the U.S. Senate?
United States senators do not like to be told what to do. I can tell you that firsthand, having worked there. I think a lot of the enthusiasm for the recess appointment idea came from House members who are much closely tethered to President-elect Trump. So you saw a lot of support for the idea from House Republicans in Trump's orbit, but major pushback from the Senate. They don't go on recess specifically for this reason, that and the pocket veto. So I do not expect the Senate to voluntarily step aside. And I think even if the president tried to force the issue, which is allowable under obscure clauses of the Constitution, the House and Senate would collaborate to make sure that didn't occur.
Henrietta, what's the concern, if any, in Washington about some of the experience levels for some of these appointments? Some people are questioning whether they are appropriately experienced to run some of these larger institutions in Washington. Is there a feeling developing in D.C.?
What I hear is a lot of agita from, the Defense Departments, for example, about some of these incoming appointees who have real axes to grind and want to get rid of Navy admirals, for example, or, get rid of major prosecutors at the FBI. That conversation, that narrative is obviously very real. I think you saw it with President Biden's decision to pardon Hunter Biden. They're taking this very, very seriously. The names that Trump is putting out there are the names of folks who have advocated, mostly on Fox News for years now, for really aggressive change at the admiral level, in military ranks, getting rid of any of these, seasoned Army generals who maybe were too, quote unquote, woke for the Trump administration and the people that they're about to announce. So there's a lot of consternation within those specific military groups. And I think that's probably the most noticeable thing I've picked up in the last couple of weeks.
You mentioned a few minutes ago Jamieson Greer, who is a Bob Lighthizer acolyte. He was the chief of staff to the U.S. Trade Representative during the first Trump term. He's now being appointed or nominated to be the next U.S. Trade Representative. It makes me want to ask you about Bob Lighthizer, somebody whose name has been bandied about a lot, but does not yet have an appointment or a nomination in this administration. What do you make of that? And I know he was sort of seen as somebody who might be a commerce secretary. Obviously, Howard Lutnick is the person who got the nod for that job in this next term. Where does he land, and what does it say to you that he hasn't gotten a spot yet?
Well, I think there's a lot of conflicting factors here, and a lot of this is sort of palace intrigue. But Bob Lighthizer was the architect of the Section 301 tariffs against China. He is the one who delivered the Phase 1 trade agreement in February of 2020 that got the U.S. and China to sort of temporarily pause the escalation of the trade war, have China commit to buying $80 billion a year over the next 2 years of additional agriculture purchases. And ultimately, China did not deliver on that. And so one of the big differences, and we're seeing it picked up in reporting right now, is that Lighthizer was going to go by the book and use the enforcement mechanism in the Phase 1 trade agreement, which would have put tariffs on in the late April, May, June time horizon, giving businesses a period of time to pull forward their purchases, get products over from China and get them into the U.S. system in advance of these tariffs going into effect. The fact that Bob Lighthizer is not going to be there, which I guess is where we are right now, I'm still sort of quasi-optimistic that there might be a trade czar role. But the fact that he's not there suggests to me that maybe Trump thinks that between Lutnick and Jameson Greer and Kevin Hassett, they can sort of disregard that Phase 1 trade agreement enforcement mechanism and go right into tariffs. I think that's probably our main takeaway this morning that I'll be talking about with clients. I don't know why there's an expectation that these tariffs aren't serious, or to the alternative narrative that the market's responding to other factors right now. But in general, I'm concerned, growing increasingly concerned, that we won't have somebody who's by the books like Lighthizer next year. We'll have folks who are much more eager to even get more aggressive than he was in his first term, which would put tariffs on earlier.
Henrietta, just briefly here, what's between now and Inauguration Day? What do we have to look forward to, again, coming out of this Trump administration and waiting?
The most important thing is what's happening in the Senate and House budget committees. We're going to get a big deficit number for their authorization in the reconciliation bill that will tell us how big the tax bill is going to be next year. That number could come out as early as the next couple weeks. The Trump administration is going to do its own thing on executive orders and immigration and tariffs and all that. But the real meat for the investment community is going to come out of the budget committees, which is wonky but true. And we should know that in the next couple of weeks. That deficit number is really all I'm waiting for.
Henrietta, thank you so much for joining us. Always get a little bit smarter when chatting with you. Henrietta Treyz, managing partner at Veda Partners, getting the latest coming out of Washington, D.C.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Apparently, influencers on the internet have important impacts on what people buy. I didn't really know that until recently. Yeah. So that's a thing out there, as opposed to a 30-second ad on television, or a billboard by the side of the road, or an ad in your magazine. That's not how it's done anymore.
The future is here.
The future is here. So that goes to the issue of what's quality information out there in the world on the web, and what is disinformation? Our next guest thinks about this stuff. Lisa Kaplan, CEO of Alethea, and she joins us here in our Bloomberg Interactive Broker Studio. Talk to us about Alethea. What do you guys do? Who are your clients? What's the work that you guys do?
Thanks so much for having me. I'm Lisa Kaplan, founder and CEO of Alethea. We are a technology company that detects and mitigates instances of online risk stemming from everything from misinformation and disinformation. So think foreign state adversaries, to also looking at where are there risks of things like boycotts, short seller attacks, other risks that can be developed online that pose serious business continuity challenges. We predominantly work with the Fortune 1000 to be able to help them understand how is it that they are being talked about, where are these risks emerging, and what is it they can actually do to get out in front of these different types of challenges.
Talk a bit more about the kind of disinformation that we're seeing. We talk about it a lot in the context of the news and journalism, sort of what people are exposed to when it comes to current events. So here in this kind of corporate setting or with retail, who's perpetrating it? What does it look like? How widespread an issue is this for some of the companies with whom you work?
When we talk about mis and disinformation, what we're really talking about is the ability to weaponize information online. And that's always something that's conducted by an individual or a group of individuals in order to achieve their goal. Oftentimes, we'll see things, especially in the retail sector, things like calls for boycotts. Obviously, December is a big month for retail. People need to do well ahead of the holidays. And one of the things that we're we're seeing that's actually an interesting development. And it actually, I would say, started really in 2015, 2016, but it's changed how it forms, is the idea of boycotting certain companies because of perceived political donations. We are starting to observe, and we saw this again in 2016 after President Trump was elected, individuals and activists calling to boycott or divest certain companies based on whether or not they made donations in support of one political candidate or another. We're seeing that again today, and we're seeing both influencers on the left and the right call for boycotts based on political donations. We are seeing what I would call manipulative attacks as well, which are when different accounts or different actors are seeking to essentially game curation algorithms, trying to make it seem as though their perspective is quote unquote newsier because it looks like more people are talking about these different trends or these different companies or calling for boycott, when in reality it may just be a very small group of very vocal individuals versus actual customers of these companies.
We've seen some pretty significant companies kind of walk away just in the last several months of their DEI, diversity, equity, and inclusion initiatives that maybe they just started even in the last 2 or 3 years. I'm surprised that companies take political stands one way or the other. As Michael Jordan famously said back in the day, Republicans buy sneakers too. Why do companies even bother doing that stuff in the first place?
So a lot of DEI programs really started in earnest as a recruiting and a retention tool. The ability to be able to make sure that you're getting the best possible talent. You have a diverse customer base. You want to have an employee in a team that actually reflects that diversity. What we're seeing now is certain activists calling into question whether or not that actually benefits the shareholder. And so what we've observed is that there's a small group of activists who are creating a lot of content and a lot of pressure on companies to essentially get rid of their DEI programs. What we've observed is oftentimes these attacks, while they start online, what will end up happening is your executives will actually get outreach from these individuals before they publicly go after you. We always recommend that organizations seek to understand first, where are your customers, your employees, and your shareholders at on this issue? It can feel really overwhelming and really alarming when you get this type of outreach, but having that data to understand what are the equities that you're trying to preserve as a private company, both in terms of making sure that your team wants to continue to work at your organization. If this is something that they care about, you should have that in mind and be prepared from an internal communications perspective. Second, where are your customers on this issue? We have seen DEI be used to target companies on everything ranging from Pride back in 2019, 2020 to today. And we also are seeing, for example, shareholders call into question whether or not DEI programs are effective. Companies that have data and data ready to share are often the best positioned to deal with these types of risks and navigate through the new media ecosystem.
I would like to ask you just about whose job it is to police disinformation in the corporate side of things. And I've been reading this book about Twitter's recent history by Ryan Mack and Kate Conger, and something they resurfaced was that moment back in 2022, I think, when somebody created a fake Eli Lilly account on Twitter, now X, and said insulin was going to be free, and we saw all of that. All the insanity that followed that.
A bad day for the CFO.
Bad day, right, yeah. But you had Twitter really doing very little to stop that from happening. And so I guess what I'm curious about is sort of how this is policed and how it's policed in a world where there aren't really, on a lot of these sites, the mechanisms in place to kind of sort through what's legitimate and what's not.
So our philosophy and why we exist as a company is because as a democracy, we're not comfortable with the idea that governments would police social media data, what people are saying online that's protected speech. We also understand that for social media platforms, to your point, this is a cost center. And so the necessary resource investment to protect the Fortune 1000 isn't going to be happening from internal cost centers at these platforms. That's just not their model. That means that the cost is actually on these private companies to be able to identify these risks and get out in front of them prior to them becoming a level 10 crisis. A couple examples of this is when we see not just the Eli Lilly example, which I think is a great example of what can happen when an individual pulls a stunt off, basically. It comes and goes in about 24 hours, and the biggest driver is actually the news cycle talking about it. What we look for is more, where is that slow drip narrative that comes data point by data point that causes people to believe something or maybe take an action or have a perception that may not be true. It's a lot easier for companies to get out in front of that if they can catch the narrative when it first starts versus wait for it to be trending on one of these mainstream platforms.
I mean, I can't imagine. It's just with the speed of social media and the velocity that these things take off. I don't know. I mean, you could, if you're a board member, I don't know how you sleep at night thinking about some of these risks there. Lisa Kaplan, thank you so much for joining us. Lisa Kaplan, she's the CEO of Alethea, talking about disinformation and how it impacts many parts of our lives, and including the economics of a lot of companies out there as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
All right, folks, your daily look at the front pages around the world. Police Mateo newspapers. What do you got for us?
All right, so did either of you indulge in the Black Friday shopping? Did you go in-store, online, nothing like that?
No stores.
Nothing?
Nothing.
No
Absolutely
Black Friday?
nothing.
Steered clear.
Okay, see, I'm the loser. And I woke up at
The
4 in the
traditionalist.
morning.
No, you did not.
And I went to the Jersey Shore outlets.
Wow.
Yes, you did. Look at you.
Which opened at 6, and I got there like 6:45. Parking lot was almost
Already?
full.
No kidding.
Okay.
Wow.
But here's the thing: this new data that's out, it shows that a lot of those bargain-hungry, American shoppers, they didn't do that. They skipped out of the in-store shopping. They went online on Black Friday. This is from MasterCard. Sales brick-and-mortar stores grew just 0.7% year over year. That's according to those preliminary estimates. But e-commerce sales increased by 14.6% online. So you see the difference there. I mean, this Adobe tally also, it showed that Americans spent about $10.8 billion online on Friday. That's 10% more than a year earlier. And then today's Cyber Monday. So
Right. See, I have a problem with this
Yes.
because you're right. Like Black Friday's become an online thing.
Right.
And then we have Cyber Monday as
It
well.
makes
I
no
don't
sense.
understand the utility of the Cyber Monday on the heels
But there
of
are
that,
still people like Lisa Mateo that get up and go to the stores. Now, I have to ask, did you go by yourself or did anybody accompany you?
No, the whole family came.
No way.
And here's the thing.
Not the soldier dude. He did not get up.
No, he did not
Yes,
get up.
okay,
My
all right.
son was sleeping.
Yes.
But here's the thing. You go and it's like you look online and it's the same exact deal.
Right.
Like the 40% off, you go in the store, you get the 40% online, the same exact time. But you do save on the shipping if you go in store. You just want one thing, So
Okay.
if you get a couple
So did you
more
get stuff?
items- We did, yeah.
Okay.
We
And they
racked
bonded.
up. And we
Can't get that
bonded.
off
Bonded.
Yes.
Oh, yeah, family
Yes.
bonding
Oh
time,
my
yeah.
gosh. We were delirious and the rest of the day was shot. But that's
Exactly.
okay. But more people actually are doing it. But you're right. You're seeing this like
right.
blending from like Black Friday,
Yeah.
which started like a week before, because
Yep.
people started putting out their sales. So anyway, which brings me to my next story
All right.
is about the return.
Right.
Okay, so when people start returning, if you notice, there's a lot of fine print now. Like a lot of the retailers are cracking down on how consumers send their items back. But a lot of shoppers are saying, you know what, we're not going to deal with it. Wall Street Journal, they say shoppers are pushing back. Some have stopped buying from retailers that charge for those returns. It doesn't seem to be affecting much because we just heard those MasterCard
Clearly,
figures,
yeah.
right? But the debate is, here's the reason, right? Retailers are saying they need stricter policies because returns and return fraud are starting to eat into their profits.
Interesting.
So that's why they need to do that. But the shoppers are saying, you know what? The sizing is inconsistent, so I have to order 3 sizes to try them on and then return the other 2, afterward.
How hard
and
or
that's a
easy
lot.
is it to return stuff, though?
I mean, with Amazon, it's easy. You just kind of do it and you print out the receipt. You take it to the UPS store. You don't even have to package it, and they just send it off
okay.
for you.
All
I mean,
right.
it's
Well,
that
that's
easy.
Amazon. They always
But that's
do.
Amazon.
Yep.
But a lot of the stores, let's say like a Saks Fifth Avenue or like a Nordstrom or a Macy's, they're starting to change the way they do
They'll
it because
charge you
it's
for
costing
shipping
them
and all
money.
that. Yeah,
it's costing them money. And with the fraud, I didn't even realize that the fraud's in returns as
Because
well.
if you're buying online, you're particularly clothes, you're taking a risk there. But people do it.
Right. People do
All
it.
right.
People do it, especially if you, like they said, the sizing. You don't know what size, so you're like, well, I'll just order a small and a medium, and then I'll return whatever doesn't
Interesting.
fit.
Okay, good to know. Good to know.
Okay, this next one is an Indian steelmaker planning to launch its own EV brand. So it's JSW. They're telling the Financial Times that they want to manufacture the EVs in India, sell them in India, but it's a growing market. You have EV makers in India like Tata Motors, Mahindra, Ola Electric. So there's a growing market for it. Apparently, this is according to S&P Global Mobility. Electric car sales in India total only about 100,000 units per year. That's about 2% of the passenger car market. But sales, they're starting to take off with more affluent Indian customers. So that's how that change is starting. So they're saying they want to get in on the action. So that's JSW. They're a steelmaker.
Why do you want to get into the auto business? I have no idea.
Well, it's a huge market, right? I mean, that's the...
Yeah, but you're a
the EV
steel
market.
maker.
Yeah.
I mean, I don't know. I mean, you look at all these auto companies, I don't know how, and investors don't know how to evaluate this transition from, internal combustion to EV.
Right.
And if you're a General Motors, Ford, Volkswagen investor, I don't think you have a clear view. That's why they're trading where they're trading, because I think the real question globally is, what's the demand for these things?
And how long is that transition going to take, right? I mean, there's a sense it was going to happen really quickly, and we've seen all these European automakers now saying, hold up, we're not going to do it. We're not going to do it cleanly. We're going to keep making these internal combustion engines for a while.
And I'm not going to pay a premium for an EV. So when I was searching for the Beamer, the guy said, I can put you in an EV, but it's a 30% premium. I'm like, that's zero
Not
value
yet.
to me.
Yikes.
I could care less about that stuff.
No, thank you.
Is your Vespa electric? No.
No, the Vespa is 50 cc's
Okay.
pure
All right.
raw
Sorry,
internal combustion
didn't mean to ask.
engine
I shouldn't
power.
have asked. Sorry.
Exactly. So anyway, that's it. I was cruising on the Vespa this
I'm
weekend.
sure you were.
All right, what else we got here?
Last one. So LeBron James, famous basketball player,
Yes.
doing great. But his media company actually lost $28 million in 2023. This was in Bloomberg's Screen Time newsletter. Check it out. This is according to Lucas Shaw. They got their hands on some documents that showed that. But it shows Hollywood production companies, they've grown over the past decade to serve the growing demands of streaming services. But now you see, as Paul always talks about, streaming services cutting back on production, looking closely at their budgets. So that's why you're starting to see this change. But apparently he lost out pretty big in 2023. I mean, he's doing quite well for himself. I don't want to put that out there too. But you see film, TV businesses started by celebrities. They're struggling to start to make a profit right now because
I don't know why they just don't do what they used to do. Just go buy a restaurant. If you want to throw your money away,
Or a dealership,
go buy a restaurant.
car dealership.
A car dealership.
Yeah.
I mean, any manager that allows these athletes or film stars to do anything but stocks and bonds, and maybe I'll give you 5% of your money to be stupid with, and go buy a restaurant or go, start a media company where Disney and Warner Brothers Discovery struggle to make money. I just don't get it. But
Love this line from Lucas. Producing good movies and TV shows is hard, and having a celebrity producer does not guarantee success.
Does not.
Good caveat. there from
Well,
Lucas.
I don't know how much you guys pay attention to this, but in the credits, look at the producers and executive producer. Executive producer is, I'm going to give you this executive producer title.
Yep.
No economics, but you can then say you're a producer.
Gotcha.
All right, that is newspapers from Lisa Mateo. Always a coveted spot in the lineup here.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.